All right, hello and welcome to day 4. Today we're getting into the narrative creation. Okay, we're actually getting into the meat and veg, so to speak. The first step to a successful trade is, of course, narrative creation. This is where we build the weekly bias, identify our trading range, locate points of interest, and then set the stage for the following day's price action. In this class, I'm going to teach you exactly how to do this. So this is what the narrative flow looks like: bias, range, points of interest. First of all, we want to identify the overall market direction. So we have our general bias in place. Then we isolate a likely trading range for the week. When we're looking at weekly candles and weekly charts, these things move real slow. So we want to isolate a likely trading range. So find a high and a low that is most likely to be filled throughout that week. And that becomes the range we trade in. If we just analyze a weekly time frame and work off of that, we are going to be waiting a year or more for trades to fill. So we identify and isolate a small trading range once the bias is formed. And then we locate points of interest above and below for our targets and for potential areas to get into trades as well. Mostly in the narrative creation, it is going to be for targets, okay? Now we follow this flow on all time frames, but it begins on the weekly. And in this narrative creation video, you're going to see us doing it on the weekly and the daily. That's where this goes down. So yeah, weekly and daily, that's narrative creation. Everything else takes place on lower time frames. So why do we start here then? Well, if your intention is to day trade primarily, you should still be starting your analysis on the weekly and daily time frames. I frequently take trades on the 5-minute, the 1-minute, the 2-minute, the 10-minute, okay? But the reason these trades work so well is because of the big picture bias that they live within. I have maximum clarity and conviction about the small moves because the big moves back me up. You're going to see this as we go through. So inside of our narratives, we have the same list of technical concepts that we've covered so far. And this is all we're going to be using across all of them: macroeconomics, structure, imbalance, liquidity, supply and demand, and momentum. Now, macroeconomics, I will show you how we utilize that in here, but the class we showed you on day 2, I believe, setting up, pretty much gives you everything you need to know. I'll give you a brief example as to what we would do first of all there, and then we'll get into each of those concepts. So with that said, let's go and begin the implementation flow for narrative creation. The first example that we're going to look at on this topic is going to be the US dollar index, the DXY. The reason why is because I start pretty much all my analysis on the DXY. Why do I do this? Because the DXY, or US dollar index, gives me an insight into the strength or weakness of the US dollar. And because I trade pairs like Euro USD, GBP USD, USD JPY, well, everything revolves around the US dollar, right? So if I've got a good understanding as to what I think the US dollar index is going to do this week, whether I think it's going to go up or down, well, then I've got trade ideas prepped for Euro USD, GBP USD, and USD JPY. And this extends to any pair that has the dollar in. And in fact, even pairs that don't have the dollar in, because the dollar is actually the leading currency in the financial markets at this point in time. It's the world reserve currency, which means it affects other currency. If the dollar's going up, we can see other safe havens, the Swiss franc and the Japanese yen, go down. If the dollar goes down, we can see other safe havens like the Swiss franc and the Japanese yen go up. Likewise, there are commodities linked to this. Now, less so recently because of big macroeconomic shifts in the world and big dramatic things going on regarding global economies. Basically, gold and the dollar were very correlated. So if the dollar was down, gold was up. It's actually less direct at the moment in time, but it's definitely worth considering because when gold isn't so erratic, we might see that return in a stronger sense, okay? But that's why I start on the dollar index. It's basically going to prep us. Everything else we want to do, we can build that from here. And funny story, I don't actually even trade the dollar index. I've never taken a trade on this. I just use it to build narrative directions, all right? So dollar index, that's where we're going to begin. And narrative creation begins on the weekly time frame. So you want to be on the 1W, the 1 week, right? This one just here at the top. When you're on the weekly, each candle is showing you a week of price action. And basically what we want to do here, as per the small explanation in System at a Glance, is identify a few things. We went through a checklist. We want to find bias, range, and then POIs. So that's what we're going to do, all right? We're going to start with bias. And we do this by doing 2 things. Number 1, we look at existing range. Number 2, we look to the left. So we're going to start by looking at the existing range. And that simply just means dialing in on basically whatever the current weekly trend is doing. You don't have to look really far back. We want to look at confined price action because, as we discussed in the previous video, this weekly time frame is exceptionally slow, right? So we don't want to be looking at what's gone on back here in terms of what we think is going to happen immediately. So For my range or bias creation, first of all, directional bias creation, I'm going to be looking basically just at the recent range, this recent bit of structure we've got. And it's quite clear from here, if we use our market structure concepts, what are they? Well, we want to identify highs and lows. We can see we have our low, then we have a high. This high is lower than the previous high. So that makes this a lower high. This low is lower than the previous lows. That makes this a lower low, already immediately indicating we're in a downtrend. And then from there, we've got a break of structure just there, which pushes us again into a lower low. From there, we've created this high, which we could see as potentially a lower high. But remember from structure, this is not validated yet. To validate that as a definite lower high, we would need to see the market make a lower low. But what we can determine from this trend, basically just looking at the market like this, is we are bearish. Okay, we are in a market that is going down. Our initial bias idea from this would be to see the market come down. Okay, so that is what we would build from there. Now, the next step outside of the existing range is to look to the left. This isn't to determine the current trend. We've done that already by just looking at this weekly range. But by looking to the left, what we do is identify if there's any areas of interest, demand zones, supply zones, points of liquidity that maybe the market has swept with one of its recent pushes, right? So for example, if this came from a demand zone, well, that could tell us maybe actually this market's more bullish than we think. If this came from a sweep of liquidity, we could think the same thing. If this was in kind of no man's land though, that would heavily back up the idea of us continuing the short bias and could allow us to easily target this low as one of our trade targets. All right, so we're going to go to the left now. Now, all we want to do when we look to the left is find the range that confines the existing range. So to explain what I mean there, if we have a big selling move like this, and then our weekly range is here, all we want to look at here is basically going to be between this low and this high, right? We don't need to look at anything else. So in terms of where we are right now, we want to look to the left to identify the confined range. And what we can see there is basically this is going to be the confining range that we've just discussed, okay? From this low to this high, because everything that's happening now is taking place within that range. I can see, looking to the left here, that we have a demand zone, which price has actually just pushed into. So if we grab that demand, draw that across, we see that this tap actually pushed us into the demand zone. So that's an interesting sign. That could give us some indication that maybe this market's going to move bullish. That's the first thing we could gather, first idea we could gather from this. But that's going to require a little bit more breaking down. It's just definitely worth keeping in mind that, look, we have had a demand retest, okay? So we've looked to the left. We found our pretty much only notable point, which is going to be this demand zone just here. We see from that existing trend that we're in a downtrend. Now we basically have our bias. The next thing we want to do is identify the range. So within a given week, we're not really going to be trading too far out of the existing weekly leg. The standard rule that we use is to identify the most recent leg of price action. In this case, realistically, it's going to be this push here because we're trading confined within that leg, this low to this high. So if we're going to be trading anywhere throughout this week, it's likely going to not exceed the high that I've just drawn on or the low that we already have drawn on. Basically, this becomes our weekly range. Anything that happens between here is likely to pretty much provide all of the week's opportunity. So that is our range. Now we've done bias, bearish, but we do consider the demand zone retest. We've done range, we've identified the local high, local low, and created a confined range for opportunities. Now we want to look for POIs, points of interest, anywhere we are likely to reverse or target. Now here on the weekly in this specific example, we don't really have any points of interest. The thing we can consider about POIs is actually to take a look at a little bit deeper into the bias, right? There's no clear supply, there's no clear demand, so we can't really gain any information from that. But what we can gain information from is what's been happening recently in the market to help us back up the bias. So the first thing that I would note is we had this demand zone retest, the market pushed up. That seems like it could be a bullish sign. However, in doing this push up, we swept 1, 2, 3 equal highs. And then we had this big bearish momentum, so momentum's going to be a big factor here, which drove the market all the way back down, pushing us back down under those equal highs. Now, what could this tell us? Well, generally when we see a demand, as we know, we want to see a strong push out from that level. We didn't get that. There hasn't been a strong push from here, which tells us that maybe this demand zone isn't so strong. When we pair that with the idea that we just swept some liquidity and we've had this big bearish reversal indicated by the huge wick, that again is a leading factor in telling us that maybe this market is more bearish than it initially seemed. The next thing we can look at then is the very near-term range. And again, we're coming back to momentum here. What do we see? What do these candles tell us? Well, I'm boxing off two little points here. the candle bodies just there, and the candle wicks. We see the candle wicks are huge, okay, rejecting attempts to go higher. And we see the candle bodies are small, and they're not really making any movement except for a small dip lower. This momentum inside of this range tells us that sellers have clearly been coming into control every week for the past 3 weeks. Every time buyers have tried to take the market higher, sellers have stepped back in and said, nope, not happening. So now we kind of use that as our points of interest. There are some points of interest here. Yes, they're not demand and supply zones, but this point of momentum, this very clear area where the market is continually rejecting this price level, and this point here where the market has swept this point of interest in the form of equal high liquidity and then again had a big sell back down. These two things, while not clearly defined zones, are telling us something about the market. And they're telling us that the bias that we initially had of bearish is pretty much 100% in check. We have structure telling us the market's going down. We have sweeps of liquidity and massive rejections. And we have complete failure by buyers to push the market higher. If we then factor all of that together, we could say, well, this demand zone retest has not played suit in the way that we generally want a demand zone retest to play suit. If we take a look back here, we have demand and then an immediate explosion. That's what we look for because demand is supposed to show us areas of significant buyer intent. If we take a look at this demand was followed by some weak candles and then a huge rejection and then even more rejections, pointing us downward, not upward. So this, again, is actually backing the bearish bias and telling us, yeah, it's not just the structure that's going down, it's the momentum as well. The individual candles themselves are telling us sellers are in here heavy, okay? So what we've done there is create our weekly range. And to recap what we've just achieved through creating that weekly range, determining the bias. So we began on the weekly time frame here. We used our bias. We used market structure, so the trend direction, lower lows and lower highs, to identify our bias. We looked to the left and we identified a demand zone, which is this one just here. We figured this demand is weak due to the momentum. And just to recap that real quick, number one, very slow push away. Number two, sweep of liquidity. Number three, big bearish momentum push back down. And then, of course, number four, following on from that, this continued range of selling pressure, selling pressure, selling pressure, and continuous bearish candles with no ability to push the market higher. So the demand, not too much of a worry in terms of our overall selling bias. At this point, we've used market structure, liquidity, and momentum to basically formulate the full idea. The market is going down. So the overall idea we create is the US dollar we will be looking to sell, which on this chart looks like this. Our trade for the coming week is probably going to be that, all right? And this, of course, because we're on the DXY, the US dollar index, sets us up with XUSD buys. Now, XUSD simply means anything against the US dollar. So Euro USD, GBP USD, these are the XUSD pairs. We would expect, this is terrible, right? And I'm sorry. We would expect these markets are going to go up now because we see this bearish dollar possibility. All right. Now, we are going to dig deeper into this scenario as we go. In a future episode, we will lead on from this, but I want to show you, based on everything we've actually looked at so far, take a look what happened over the next week. So you can see we had this selling move, which brought us down to take out the range low. So what we define there as our selling opportunity would definitely be something we could have taken advantage of and would have provided some very healthy trades throughout that week. Okay, so that's our first example. Now we are going to, as I said, continue on with each of these examples in the refinement and trading identification stages. But for now, let's take a look at another example of narrative creation. Okay, let's take a look at another one then. We're on the weekly time frame, this time on GBP USD. I've gone to a different time to the previous one, so that when you're seeing these examples, they're all slightly different, so you can get a feel for kind of what this looks like, okay? So the first thing we've discussed is we want to identify bias. That just means looking at a confined weekly range to identify which way the trend is going. Well, if we look at this from, the big picture, we can see this is making higher highs and higher lows, all right? So we are in overall an uptrend there. Now, if we want to look at a more confined range, and this one, by the way, is a little bit cleaner than DXY that we just looked at, because on the DXY, we had this huge imbalance and then a small range down here. So we only really wanted to look at this. Here we have additional benefit of being able to see basically quite clearly this market is on this bigger picture moving up. What's more important as well is going to be what's going on in this confined range. So we are going to look at just what's gone on from this low to this high, the more zoomed in weekly view. And again, we can see we have a push up, high, pull back, higher low, push up, higher high. So we actually have validation again. This is a bullish market, okay? Another thing we can consider alongside structure, of course, is momentum. If you take a look at the momentum of this market, again, referring to the speed and size of the candles, it's pretty clear, okay? Strong buying candles, very small, weak selling candles. And again, these candles here, very strong and impulsive, little to no wicks, so we're not seeing much rejection from sellers. It's a very clearly buyer-dominated market, all right? Now, we've looked at the confined range. What do we want to do next? We want to look to the left, okay? What we want to do over here is see if there's any points of interest like liquidity, swing highs, swing lows, and supply and demand that could potentially change the narrative. Now, when we take a look at the range here, which is our confining range, remember we said we pretty much want to look high to low of the range that confines our smaller range, okay? So again, just to map that out, we basically say if our trading range is here, we use this low, this high, that's our confining range. Our confining range here is going to be from this high to this low, simple format. And we can see everywhere inside of this up to the swing high is efficient. There's no imbalances, there's no inefficiencies. So therefore, having broken over this high and pushed into that efficient range, what do we know about efficient ranges? Well, we know when we break into one, we are very likely to go all the way through it. So from looking to the left, we determine that this is basically no point of reversal, no worry there. And then this swing high becomes a pretty clear target that we could look to take the market up to for any buying opportunity. Okay, so we've built the bias, we've built the overall directional idea. And to quickly recap it, it basically tells us the big picture trend is up, this confined trend is up, we have a break over a high into an efficient range here, which tells us there's no point of reversal. Therefore, considering we're pointing upwards, our big picture target is going to be there. Okay, so that is the initial idea we've got. That is bias. Now we want to identify range. So when it comes to creating our range, as we've said, we want to look at the recent leg of price action. For us, realistically, it's going to be this. It's the recent leg, low to high. So our range low is basically going to be down here. That's very simple. That's locked in. That's defined. However, we're in a little bit of a different situation here. That's why I wanted to show multiple examples. If we use this as our range high, we're basically already there. And we understand at this point that if the market is going to keep buying, it's possible that it would buy up towards the next target, right? Which essentially means our range high would be instantly taken out as soon as the market opens. And then we would have to identify a new one. So what we can do is just ahead of time, identify a better range high right now. So our range low is pretty locked in. It's going to be the low of the recent leg. But our range high, given what we've just discussed about the efficient range and the bullish structure and the bias of buy-side trade, could actually be drawn to here. Because if we go up immediately into the week, where are we expecting it to go? Well, we're expecting it to go up anywhere up to here, which means this also fits within our weekly trading range. So our range high to range low in this week is actually going to be a little bit larger, but that would kind of match the impulsive nature of this market. We wouldn't expect the market to go any lower than this, and we wouldn't expect the market to go any higher than this. And any trades that we do take this week are likely to be taken within this range, okay? This could be maybe a sell down and then a buy up. That is what we could look for as our upcoming trade. All right, so that is pretty much everything we need to do here on the weekly in terms of narrative creation. Again, let's go through it, what we've discussed so far. So we looked at market structure. Okay, that's concept number one. We looked at momentum, strong up candles, weak slow down candles. That's concept number two. We used market efficiency. We saw efficient market here. This is therefore becoming our target. This is also kind of liquidity, right? This is swing high liquidity. So we have market structure, momentum, efficiency, and liquidity all prepped in here, helping us build this narrative. And then the final thing we want to do, as we've said, is determine POIs, points of interest. We kind of did that up here in the range creation. We identified this swing high is definitely a point of interest for target. Now, the other POI that we would want to look for, which wasn't prevalent in the DXY example, is supply and demand. Because we're in a buying example, we are obviously like to look at demand zones. Demand zone is down there, and we have, again, imbalance into that. So that becomes a definite thing we want to focus on this week. Because obviously, if we get reversals, our trading week could look like this, and then maybe next week could look like this, for example. Okay, so that is kind of the next consideration from POI perspective, just making sure we have that demand plotted. And then we could as well look for supply zones over to the left, but we already did this and there isn't any, so we don't need to worry about that. So that is narrative creation for this GBP USD setup, right? We come to the markets with a naked chart. There's nothing going on the chart. And all we do is we read the high to low structure, the momentum, we identify for any liquidity, imbalances, and supply and demand zones, and these things combined give us our narrative and idea for the week. So if I was jumping into this, and again, we will go deeper into this narrative creation in one of the future episodes, we'll come back to this specific pair so we can carry on the flow. But for now, let me just show you, I would look for, if we got reversal, sell down. That would likely be the core trade of coming weeks. And when this level is met, we would look for buy up, and that would be the continued narrative. Now, to show you how this went, as you can see, this is a little bit of a drawn out trade, but remember, these are weekly candles. So we have here 3 weeks of easy selling, right? Week number 1, we'd have a trade in there. Week number 2, we'd have a trade in there. Week number 3, we would have a trade in there. And then week 4, another week of selling into a reversal. And then following on from that, the next couple of months actually led through into very clean buying. All right, so you see how that narrative was formed from start to finish. Obviously, not how we actually trade it just yet. We're covering that in the next couple of classes, but you saw how that creation came to be from start to finish and how that formulated into very simple trade opportunities. And in this case, not just providing trades for a week, but actually setting us up with around 6 weeks of profitable, clear, high clarity directional trading. That's that one. Let's do another. All right, now let's take a look at another example of a narrative creation, this time on USD JPY. Again, we start on the 1 week. This one I've done because it's a tricky one. This is not really a very clean directional bias. And sometimes the markets will look like this. There'll be a bit of a mess. You're going to find it difficult to work out which way the market should be going. So I want to cover that here. So step number 1, as discussed, is to find the bias. We do that first of all by looking at the directional bias of highs and lows. We can see quite clearly from the existing trend from this low, we have a high, higher low, higher high. All right, so this is an uptrend. Now, next thing we do is look to the left. What do we want to do when we look to the left? We want to identify POIs, liquidity points, supply and demand zones, all the stuff like that. What we can see over here to the left is there is actually a supply zone. So this is a little bit more clear than the DXY example we looked at where there wasn't any clear POIs. This one has actually had a supply retest and the market is now coming down a bit. So we have here a difficult situation because we have predominantly an uptrend, but we're at a point where the uptrend could potentially be coming to its close because we've hit a supply zone and we've had this large momentum wick rejection pushing the market back down. So this is one of those phases that's a little bit harder to gauge in terms of what the market is up to. Now, of course, we could say, yes, this is a bullish market and we want to keep buying it, but now we've got the conflict of this supply zone, which kicked off a very strong bearish move, and the supply zone retest, which is again now with this wick, kicked off a rather strong bearish move. So we could say, yes, although it could buy in this uptrend, there's possibility that this is actually the end of the uptrend and we may come down through these lows. So that's the bias I would build from this. And now what we need to do is make sense of this. We need to try and package this into something we can actually trade in the week ahead. So we've created bias. Now we want to create range. Obviously, as we say, to determine range, we just look at the previous leg of price action. Really, I'm going to look at 2 little legs here. I'm going to look at this one, which is unconfirmed as of now, but it takes us from this high down to pretty much the lows that we've created since then. So we could look at this as a low and we could look at this as a high. Now, the one thing we're always doing here is just determining where do we think this market could go this week, all right? So we can kind of expand these things. We can work outwards a little bit. And I would actually work outwards to this low here. The reason I would move the low from there to there is simply because beneath here we have efficiency. There's no demand zone here that's creating any reactions. Therefore, we could expect if the market takes that low, it is quite highly likely to take out the next low as well and trade towards at least the imbalance that we've got going on there. So the high is pretty much baked in. It's very simple. If we're going up, we're going to go up to there, okay? But the low, I would say, generally, if we're going to go down, the next point we would want to target is that. I did say I was going to look at 2 legs of price action, and here's that. So we have this push as well. This is the previous leg. So we have the low to the high. This is separate to the one we've just looked at, but actually gives us more information because this leg up has got an imbalanced demand, a POI, point of interest. So this POI sits just underneath that liquidity we've just drawn on. This could actually allow us to potentially extend our trading range in to include this area of demand. Now, the way that I would view this while building my trading range would be simply, I would use this as kind of a first target. So I would keep this as my initial weekly low on the range that I'm creating. I would keep that as the high. That high is very simple and straightforward, and I do like that one. But what I would do is also understand that there may be potential over the week or over following weeks to extend this low out towards this demand. Okay, because we create a range here where the market can easily trade down into that level of demand, regardless of whether it's then going to trade higher or trade lower. If we are going down at all, we should come into this area of demand, okay? So first things first, I would use this low that we've just drawn on. Think that's a super simple low. Obviously, then if we come down to that level, we liquidate, sweep, and drive higher. We've locked in profits on any short position trades that would come in. But if we do then get under this low, close and stay looking weak, we can extend that even further through into the area of demand here on the week. So that's pretty much everything. Let's round it back up. We first of all step in with the market structure concept and identify the high-low structure of this move to see this is a moving uptrend. We then look to the left, again using structure, liquidity, imbalances, all of those concepts, and we see there is an imbalanced supply zone which has been hit. We then use momentum and we identify that after being hit, the market saw a big sell-off back to the downside. Then following that, we've now had some flat weeks of price action with pretty clear indecision, which tells us the market doesn't really know which way it wants to go. So what we've resorted to is actually creating a range of liquidity, a swing high and a swing low as our two upside and downside targets. And what we will now be doing throughout this week is looking for opportunity dependent on lower time frame price action to either trade down into here or trade up if we get that shift into here. Okay, so this one is a bit trickier and will rely more on some lower time frame work to actually find these trades and make them happen. But as it stands right now, we've pretty much got our bias locked in. We would say we're in a limbo phase is how I phrase it. We don't know whether this is going to go up or it's going to be the end of the uptrend and go down, but it doesn't really matter because we've formulated 2 points of clear liquidity on the up and downside that will allow us to find our trades through the week. All right. Again, to do this, we use all of the concepts: market structure, momentum, liquidity, supply and demand, market efficiency, and we pair that in with this kind of standard routine, identify the trading range, identify POIs to the left, identify POIs inside of the current range, and then work out where those targets may lay inside of here. Now, in real time, this was a market that I found opportunity to sell through, and I'll show you this in a future video when we get to refining these narratives into actual trades. But just to show you how that went, we obviously had a little bit of a pull around and then the market made it sell down, tackled that liquidity at the low. And this was a slow moving range, all right? This is what we would class as suboptimal trading conditions. When we have market conditions like this with about 5 weeks or 6 weeks of pure indecisive price action, this is generally a market phase we would rather either not trade through or trade incredibly passively through while we focus on other assets. And that's exactly the way that I approach this market. But it did create sells here, more sells there, and final sells there, which actually means regardless of how messy this weekly is, there's still potential inside of even the ugliest of charts. So we built nice liquidity range out of this one, and that is example number 3. Okay, the final one that we're going to go through in this narrative creation video is going to be Euro USD. So at this point, we'll have covered the full list: dollar index, Euro USD, GBP USD, and USD JPY. Now I've picked different market scenarios rather than running them all alongside each other, so you can see different phases in the market and how we would approach them. We're going to break down Euro USD now from the weekly perspective. We're going to follow this standard flow. So let's do that right now. Okay, the first thing we want to do is identify the trend. Now, quite clearly from the weekly, we can see this is an exceptionally bearish market, given that we have printed bearish candle after bearish candle after bearish candle the entire way down from the top. We can see on the bigger picture, we are kind of bullish. But what we're actually doing at this point is making our first push into lower prices, okay? We've created essentially equal lows, a very light new lower low, but it is a wick here. So we don't quite classify that as a shift in the trend at all yet, but it is indication that given that we've pushed into this low, we may end up going lower. Now, what we would then do to identify where we could potentially go on the downside is, of course, look to the left. So looking to the left from this range here, first thing we see is a demand zone just here. This blue candle, indecision candle, it's an area of demand. And what can you see from what the market's done here? Well, you can see this is a demand fail. So this gives indication that maybe the bias is going to be pushing to the downside because there's not really much reason for the market to make a shift from this level. With that in mind then, the market breaking under this low, we would look a little bit further to the left. Understanding now that the market is likely to move lower, we need to work out where it's going to go. The next point we can see is this area here is all efficient. There's no open imbalance demand. So if we're pushing into an efficient range, we expect the market to push through the efficient range, creating this swing low as a nice liquidity target. So based on what we've got right here, we can see bearish market in the short term, demand failing in market structure potentially leading into a break, efficient range beneath, and clear swing low target. Therefore, the bias for this week is likely going to be to sell through this range, just like that, okay? So we've basically seen demand failing, this low is starting to give way, and if this low gives way, there's a clear run down towards the next low, which should provide us with a week of trading opportunity on the sell side. Now that is actually a very simple one for us to go through. We create bias by looking to the left and looking at the current range. We see exceptional bearish momentum, no buying control at all for like 10 weeks. We see demand failing, again, no buyer control. We see this low failing, no buyer control. We see efficient range, no reason for buyer control in there. And we see a liquidity target. All of this points us to believe in the short term, we are likely to move down. Now, this could be a sweep reversal trade, but if it is, we would expect it to take out the lows beneath the efficient range, right? So regardless of whether we think this market's going to go higher or lower, in the longer term, the short term is pretty dialed in. It's going to be a straight sell from there into there. In terms of trading range then, how we isolate this into an actual range for the week, well, I'd just keep it nice and simple. We could say with the fact that we have a very small imbalance into this large wick candle here, okay? We could say that our range high is going to be pretty much there. So if we trade upwards, we should remain confined under this high. And our range low, we're just going to go ahead and set the range low to this level here, because of course that's our downside target. So we essentially created a range now between this high and this low. In all honesty, I wouldn't expect it to get that high, but if we are going to move up, that would definitely be the confined range we'd look for. We could identify selling anywhere underneath there. And if the market broke above that, well, then that would completely change the game. We would likely step out and come back on a following week once the market has, reset the narrative with a new idea. But for now, I'd say this is a nice high, this is a nice low, and ideally we're looking to trade it anywhere from pretty much under the previous weekly candle. We're just looking at a bearish market here, and we want to keep this bearish flow going for the most simplistic trades. So what we might like to see is this, but we leave the range high up there with the understanding that even if we do get up there, we do still remain weekly bearish, and we should be getting that fill. So again, I'll come back to this one and share the refinement and trading opportunities from it, but let's just show you how it went. As you can see, we had a week of pullback. So the following week's price action, again, as we showed you in System at a Glance, this candle here would actually be the pullback trade. So we would get this in the following week. And then as we traded into the high there, we saw the rejections, which set us in for essentially a selling situation to fulfill the target that we prepped with that weekly narrative creation. Okay, so that's basically what we're looking at here. Big picture, well, small picture. We're looking at the big picture version, and that is the narrative that we built here. So that is the final example for this class. Okay, so to recap every step of the journey from a clean chart through to a built out narrative, the initial creation. First of all, we identify the trend by looking at the near term price action. We can see from this example, especially if we include this high, that we've had a break of structure over there, which sets us more into a more net bullish tone on the big picture. But on the more refined view, we even see that this is continually forming higher highs and higher lows. Therefore, at least for the moment, this is a market we would classify as an uptrend, and we most likely want to look at buying. Next, we look to the left. We do this to identify points of interest, generally liquidity and supply and demand. We can see from this example, we have 1, 2, equal highs. We would also see above maybe a supply zone with imbalance into it, which sets us up with a potential upside target, further backing the narrative that, number one, liquidity acts as a magnet for price, so we would expect that this is quite likely to be filled. And number two, if that is filled, then we have possibility of trading further through the imbalance into the supply zone above. So that would be stage one to narrative creation. Next is finding our trading range. Generally, as we said, we just want to look at the previous leg of price action. So what we would do for our low of our range would be to simply set it to the most recent low. We wouldn't expect the market to get beneath that level within the coming week. So that's a good place to kind of put the lower point of our trading range. Now the trading range high, as we can see, we're trading right here. So we don't want to set it to our most recent high, otherwise it will be immediately taken out in the week. So what we can do instead is just look upwards a bit and see where our targets lie. And of course we have a target clearly locked in. First of all, and remember we're on the weekly, so this is far away. First of all, at the point of liquidity. So our range high could actually go here. We're basically anticipating trading between the low that we created and the upside liquidity target. So that creates our trading range for the week. To confine that to what it would really look like, it would essentially be this. Any price action trading we look to do this week will happen inside of here, okay? So we have bias, we have our range. Now the final thing is to identify points of interest. Generally, they're going to be areas we may want to buy from if the market pulls back. If we've already built a bullish bias, we are generally then going to be looking to buy from demand zones if they are filled. So we would look and see if there's a demand zone down here. And if there is, we would plot that on. That sets us up then with this week's price action most likely trade actually being a sell down into the point of interest. And then following week's trades would be the ride back up to take out this high and potentially extend through to there. Okay. So remember, when we're building narratives, it's not always about building what's going to be the next direct trade opportunity, because of course this narrative sets us in motion for a bullish trade. We'd be looking to buy based on this. But what we're actually doing is just building that big picture context, because that allows us to find the more immediate trades. If we know that we are bullish on this market, we want to target this level and we want to buy from here, well then any confirmation that shifts us back this way is a clean and easy trade for us to sell back down, targeting that level. And that is likely going to be the trade that we take over the coming week. And then we can shift into the bigger net bullish picture as and when the market tells us to do so. Okay, so narrative creation is less so about finding the trade opportunity and more so framing potential opportunities that can come in within a solid understanding of the big picture context. And that is exactly what we've done over these examples and this little diagram as well. So hopefully that's sitting in your mind now. Let's show you what you need to do next, and then we will move on to narrative refinement. Okay, so you've seen the narrative flow now in action. We check macroeconomics to build our overall macro bias. We check the US dollar index to set ourselves up with the bias for the week inside of the assets we're going to be trading. And then we run through the rest of the list and do the same, mapping out directional ranges, points of interest, and the overall bias that we might have. So we identify bias, we identify a confined range on the weekly, and then we identify points of interest and targets the market could potentially move towards throughout that week. We then refine on the daily the points of interest, the ranges, and the biases so that we can find trades inside of trades, or at least just find the first opportunities to trade to and from different POIs inside of the weekly. Hopefully you see it's rather simple and it's very repeatable, okay? Narrative creation is the first core step, and now you know how to do it. You'll see how this evolves into trading opportunity over the next few classes, but for now, the foundation is set. So before you move on, there are some things for you to do. Explore the subclasses and resources as usual. Watch some more narrative examples, there's a couple more in there, and rewatch any of this recording if that is required. Do not rush yourself through this process. If you feel like you need a little bit more time, give yourself a little bit more time, okay? If you've got everything locked in, you're gonna have better results long term. And when that is all done, meet me for day 5. So check out those resources and I'll see you over there.